All right, dear students and scholars, welcome back to our ASC 320 series. In the previous video, trading securities took us straight into earnings. Now we move to available for sale debt securities or AFS securities, where the route is different. Under US GAAP, AFS debt securities are reported at fair value on the balance sheet, but unrealized holding gains and losses generally do not immediately enter net income. Instead, they go through other comprehensive income or OCI and accumulate in accumulated other comprehensive income or AOCI within stockholders' equity. Interest income and realized gains or losses still go to net income. So AFS is not ignore fair value. It is fair value reporting with a different landing zone. AFS is the residual category under ASC 320. First, ask whether the entity has positive intent and ability to hold the security to maturity. If yes, the security may qualify as held to maturity or HTM. If not, ask whether the security was acquired principally for near term sale or short term profit taking. If yes, it is trading. If the answer to both gates is no, the security generally lands in AFS. This makes AFS flexible but not rule free. It is not a bucket for confusion or convenience. Think of AFS as the category that says we are not locked in until maturity, but we are also not actively trading for quick profit. Once a debt security is classified as AFS, the balance sheet carrying amount updates to fair value at each reporting date. That is the measurement side. But the income statement treatment is different from trading. The difference between amortized cost and fair value creates an unrealized holding gain or loss. For a standard unhedged AFS security, that unrealized change does not enter net income immediately. It flows through OCI and accumulates in AOCI within stockholders' equity. Also, remember the balance sheet classification point. Current or non current presentation depends on working capital intent. So AFS uses fair value, but the unrealized gain or loss usually waits outside net income until realization. This slide is extremely important because AFS accounting separates different income statement and equity effects. Interest income belongs in earnings. Premium amortization reduces interest income in earnings. Discount amortization increases interest income in earnings. Realized gain or loss on sale also goes to earnings. But unrealized holding gains and losses at period end generally go to OCI and accumulate in AOCI. This is the common exam trap. Students sometimes see AFS and send everything to OCI. That is not correct. AFS does not mean all items avoid earnings. It means unrealized fair value movement usually avoids earnings while the security is still held. AOCI is the equity location where cumulative AFS unrealized holding gains and losses are stored until reclassification. OCI is the period flow. AOCI is the accumulated balance. That distinction matters. If fair value increases this year, the current period gain goes through OCI, then that amount becomes part of AOCI in stockholders' equity. If the security is later sold, the related AOCI amount is reclassified out of equity and into earnings. So AOCI is not a mysterious drawer where accounting numbers disappear forever. It is more like a very organized waiting room. The amount waits there until realization gives it the ticket to earnings. AFS is not all OCI. Interest income still hits earnings. Cash interest received during the period is recognized in income. Premium amortization reduces interest income using the effective interest method. Discount amortization increases interest income over the life of the security. The effective interest income amount is the net total recognized in earnings each period. This is true for HTM, trading, and AFS securities. The difference across categories is mainly where unrealized fair value changes go. So when you see an AFS debt security, do not send interest income to OCI just because the security is AFS. Interest income knows its home address, and that address is earnings. Now let us apply the rules to a simple 2026 example. On January 1st, 2026, an AFS bond is purchased and classified under ASC 320. At year end, the amortized cost basis is $101,200. The fair value from the market quotation is $105,000. Tax effects are ignored for teaching clarity. The key question is, where does the $3,800 fair value increase go? The calculation is straightforward. 105,000 minus 101,200 equals 3,800. But the accounting answer depends on the category. Because this is AFS, the unrealized gain goes to OCI, not net income. At December 31st, 2026, the AFS bond must be marked to fair value. The fair value is $105,000 and amortized cost is $101,200. So the unrealized holding gain is $3,800. The journal entry is debit AFS Debt Securities $3,800 and credit unrealized holding gain in OCI $3,800. Net income is not increased by this unrealized gain. The bond now appears on the balance sheet at $105,000. The reconciliation is clean. 101,200 plus 3,800 equals 105,000. After the year-end entry, the $3,800 OCI gain accumulates in AOCI within stockholders' equity. Beginning AOCI is 0. Current OCI gain is 3,800. Ending AOCI is therefore 3,800. At the same time, the AFS bond is shown on the balance sheet at $105,000. This helps you see both sides of the reporting picture. The asset is updated to fair value, and equity stores the cumulative unrealized gain through AOCI. In simple terms, the balance sheet carries the fair value, while equity remembers the unrealized movement that has not yet gone through earnings. Now, the bond is sold in 2027. The sale price is $106,500, and the carrying fair value before sale is $105,000. That creates an additional gain on sale of $1,500. But there is also a prior AOCI gain of $3,800 that must be reclassified into earnings. So the total realized gain in earnings is $5,300. That also reconciles directly. Sale price of 106,500 minus original amortized cost of 101,200 equals 5,300. The sale entry records cash, removes the AFS debt security, recognizes the additional $1,500 gain, and reclassifies the $3,800 AOCI balance into earnings. This avoids double counting. Accounting does not like deja vu when the same gain tries to appear twice. There is one important exception to the normal AFS path. Normally, unrealized holding gains and losses on AFS securities go to OCI and accumulate in AOCI. But if an AFS security is designated in a qualifying fair value hedge under ASC 815, the hedged portion of the unrealized gain or loss is recognized in earnings instead of OCI. The slide separates the normal AFS path from the fair value hedge path. For this video, do not get pulled into detailed hedge mechanics. The key boundary is enough. AFS usually uses OCI unless qualifying hedge accounting changes the landing zone for the hedged portion. This comparison table brings the three ASC 320 categories back together. HTM uses amortized cost, and unrealized changes are not recognized on the financial statements. Trading uses fair value, and unrealized changes go immediately to earnings. AFS also uses fair value, but unrealized changes usually go to OCI and accumulate in AOCI. Interest income goes to earnings in all three categories. So AFS is the fair value category with OCI parking. Trading is also fair value, but it has no OCI buffer. This is why classification matters so much. The same bond can have the same market value, but the financial statement route changes based on the category. Let us close with the AFS checklist. First, AFS applies when the security is not HTM and not trading. Second, the security is measured at fair value on the balance sheet. Third, interest income, including premium and discount amortization, goes to earnings, not OCI. Fourth, realized gain or loss is recognized in earnings when the security is sold or otherwise disposed of. Fifth, unrealized holding changes usually go to OCI during the holding period. Sixth, AOCI stores cumulative unrealized effects in stockholders' equity. Seventh, on sale, AOCI is reclassified into earnings to avoid double counting comprehensive income. In the next video, we will look at transfers between categories, credit loss recognition, and the boundaries of AFS reporting under ASC 320. If this lesson helped you, please like the video, subscribe to the channel, support the course, and share it with your colleagues who are learning US GAAP. I will see you in the next video.